Good morning, good afternoon, good evening. Welcome to EIG's 56th webinar, a fireside chat discussion with our guest experts from the industry, Dani Kaplan from SMC Data and Greg Schlegel from the SMC Supply Chain Risk Management Consortium. We look forward to an interactive discussion with each and every one of you through the chat. We hope that your family and you are happy and safe. Again, thanks for joining us. We appreciate you taking to attend our Enhanced International webinar on building evolving, resilient, and sustainable enterprise. And we really value your time and your insight for this webinar, Fireside Chat. So please enter your comments and questions in the chat if you would. This is the second webinar in our series on end-to-end supply chain visibility and sharing best practices to achieve supply chain control. Today's webinar focuses on addressing customer demand cadence and how it can build and how to build an intelligent supply chain visibility. As we know, best in class is made up of people, process, data, and technology. And it's through these things that we can improve our cash flow, enhance customer experience, and increase revenue. Therefore, we will, at the end of the day, share with you in our discussion that ERP implementations do not need to be disruptive if we follow the people, process, data, technology roadmap. We look forward to an interactive webinar again with your comments in the chat. My name is Jim DeVries. I'm the founder of Enhanced International Group. International Group is an exchange of passionate experts to guide your transformation to provide self-generating and self-funding results. We have over 50 consultants, consultant companies, and SaaS providers that provide thought leadership that are vetted as best in class. EIG serves as a master integrator to provide you access to the best and brightest companies. We're like a Swiss Army knife. And our team is dedicated to empowering your organization's workforce by leveraging EIG's partners' tenured thought leadership expertise. Our goal is to meet and exceed your expectations with customized, predictable, sustainable, and repeatable 90-day self-funding programs, providing you the competitive advantage. Today, we're fortunate to have with us two highly respected leaders, Dani Kaplan from SMC Data and Greg Schlegel from the Supply Chain Risk Management Consortium. Dani, a few words of introduction.
I'm Dani Kaplan. We established in 1980. We have supply chain software for manufacturing, distribution, and food mid-market.
Thanks, Dani. Greg?
You bet. Thanks, everyone, for attending. Greg Schlegel. I'm the founder of the Supply Chain Risk Management Consortium. We'll talk a little bit more about the profile of that in a minute, but I spent 8 years as an IBM supply chain executive consultant across multiple industries, 35 years as a supply chain exec for a couple of Fortune 100 manufacturers. I've taught supply chain at 6 different universities, including Lehigh and Villanova here in Pennsylvania and New Jersey. And I was the Apex, now ASCM, president of the organization back in the late 90s. Back to you, Jim.
Thanks, Greg. Thanks, Dani. I just want to remind you that there's a series of webinars from EIG. Before we get started, we're actually doing a webinar tomorrow on digital twins with Vitos, one of our partners. We're also geared to do promoting supply chain risk and resiliency to be a priority in your company on April 12th with Greg. And then we'll be having some upcoming webinars on artificial intelligence, new product introduction, and generating informed decisions with data. So with that, Dani, a brief overview.
This is my It disappeared, Jim.
Go ahead, Dani. Go ahead. Go ahead. Don't worry about me.
That's my background. I've been established a company in 1980. And in 85, I made the executives, written trade magazines. And today I represent supply chain software.
Okay. Greg?
Yeah, you bet. Give you a quick thumbnail sketch. I think we have that slide in there, but nonetheless, we're an organization of 30 companies, about 1,700 supply chain risk professionals around the globe. We operate in 23 countries. All the companies on the right basically bring tools, techniques, and methodologies, and some software solutions to help us identify, assess, mitigate, and manage supply chain risks. On the left side is what we do. We have 2 online education courses resulting in certifications. We do a heck of a lot of virtual training like this, maybe 3 webinars a month for the last 20 months. We used to do classroom training. Remember those days where we used to have face-to-face actually in with the client? We're hoping that comes back. We provide certificates and certifications. We do assessment, awareness, mitigation for companies. We bring best practices in this space from our book. We coach companies. We help build supply chain war rooms. We bring visibility from several of the software as a service companies. We are very excited because we have 2 new online, we've gone online, 2 new online assessments using AI and ML algorithms. One is supply chain management readiness, which we'll talk about later in the session. And the other is prescriptive online 90-day action plan. And we'll touch on that. So quick thumbnail sketch. Jim?
Thanks, Greg. And Dani, back to you. I'm sorry I lost connectivity. Go ahead.
Okay, we have supply chain software for the manufacturing, distribution, and food. It's an integrated software. What it means is the distributor can be a manufacturer be a distributor, and a food company can do both, manufacturing and distribution. In today's world of M&A, companies a manufacturer buy a competitor, a distribution company to lower the cost, and a distribution by manufacturing to lower their cost. They end up with 2 ERP software, which create integration issue. With our single database, which enable manufacturer to be a distributor can be a manufacturer, and a food can be a manufacturer and distributor, and it's geared for the mid-market.
Thanks, Dani. Sorry about losing connection earlier. And just a little bit about EIG. I think we already went through a little bit about EIG's background, but just wanted to show you our bicycle slide here. The EIG team has modeled the company's ecosystem as these 2 wheels linking strategy to execution. We've all heard about the saying that we're only as strong as our weakest link. And we take it a step further in following the analogy of the bicycle. The drive pedal wheel represents the strategy, how to get there, and the execution wheel is represented in the rear wheel or the rear gear. And with one strong wheel pedal and the driver and the strategy, you're going to be able to result in many execution cycles. So simply said, life is like a bicycle. To keep your balance, you got to keep moving. So we work to gain your competitive advantage by optimizing your ecosystem with our 50 consultants, consulting companies, and SaaS providers. With that, we'll go ahead and get started. A little bit of background. We did have a webinar 1 about a month ago, and that's available on EIG's website to download and look and review. Today, we are covering the customer demand cadence. Next month, we'll be focused on optimizing push-pull inventory. That's a very good discussion and very, very interactive. Do you want to push or pull? Environment, supply chain, and then webinar 4 will go to creating supplier visibility to make informed decisions. And that'll round out the series. So we're going to kick it off this morning with kind of bringing back for us old timers, when we used to watch Westerns quite a bit growing up. And what we did was, what this analogy is, up until fairly recently, from the good old days, in the 1880s, we had Trading Post, then we had Woolworths, then we had JCPenney, and then the big box retailers such as Walmart and Costco. And now we want to get to that last mile. So what's happened with the pandemic, it has forced us to deliver direct to homes, where we never had that before. We had always go to some big box retailer or the Trading Post, so to speak. And now the OEMs are getting into the game of going after delivering straight to the home, thus creating the omnichannel, which we'll be talking about in a few minutes. So with this, I'll ask Greg and Dani, have any additional thoughts on this slide?
My first flush reaction is, being in the business of supply chain for 40 years, the game has changed. All right. Yeah. The horses or the customers are driving the bus now.
Yeah.
Not the big box folks. It has changed. And if you can adapt, there's some risk associated with that.
Yeah, the last ones to adapt to managing this last mile are going to be the ones out. And that's what you're going to see. They're going to blame the pandemic, but this is going to cause a lot of companies strife if they don't get on it. Dani, your thoughts?
The pandemic created a brand new reality where the products are being shipped directly to the customer now. So the shopping malls are being closed now because customers are buying we all buy on the web now. It's a brand new reality that business have to adapt to. Instead of shipping it to the warehouse and then shipping in the store, it gets shipped directly to the customer home or apartment. It's a brand new reality business have to be adapted to now.
It is a brand new world. So a brave new reality, as Dani likes to say. Thanks, Dani.
Brave new reality, new world.
Yeah. All right, so that creates this omni-channel. So from ship to the factory all the way to the customer, you could ship inventory in transit, in C, and then it's shipped to a warehouse DC, shipped to a dark store, shipped to a retail store, shipped to a pop-up node, all in the throes of getting to the customer. And this is how we traditionally looked at supply chains, I would say up till probably 2010, for the most part. But now there's all these new different ways to get to the customer. And I want to thank McKinsey, because this is McKinsey's charts, not mine. And it's just so good. Why change it? So they do a fantastic job of describing things. We'll be referencing this McKinsey material from 2021 in December that they wrote an article. The reference is on the left. When you get the slides, you can look it up. Fantastic article, very, very well done, McKinsey style. So with that, any comments or questions on this particular slide? Dani?
It's a brand new reality we have to face now, that if we like it or not, it's a new reality we have now. And manufacturers and distributors will have to adapt to this reality, because what worked in the past will not work now. And the shopping malls are paying the price now of the customer not coming in, and they're being closed.
Thanks, Dani. Greg?
It seems obvious to everyone who's in supply chain. The supply chains have become much more complex than ever before, folks.
Okay. Oh, let's keep moving on here. So I get to the agenda here. We have a 4-part agenda, dampening the demand volatility effect on supply demand execution in the bullwhip effect. Then we'll talk about retail omnichannel revolution, delivering the last mile, and then leveraging ERPs to enable this robust demand cadence capabilities. And we'll wrap it up with a case study with Dani. And just to keep in mind, we talked about 3 best practices. I'll call them out right now. There's a roadmap that we'll give you, the supply chain readiness survey on how to get there, which Greg will cover. We have the bullwhip effect and S&OP demand planning, balancing, and having a strong ERP to help you, and then cost to serve. And then I'd say we even have the bonus of the customer supplier demand visibility, which Dani will cover. So we have really 4 best practices that we will be covering in this session. So with that, Greg, the bullwhip.
You bet. Thanks, Jim. We call this the bullwhip effect on steroids. It's been with us since since about 40 years, if you're in supply chain,
Yeah.
But it's really been amplified over the last 2.5 years with the pandemic and all the disruption. So we just want to give you a thumbnail sketch of what it is. Bullwhip effect is the uncertainty caused from what? Distorted information flowing upstream to your suppliers and downstream to your customers. So it's end to end, and it can get nasty. On the left-hand side of the graph, you can have demand shocks from your customer. On the left-hand side of the squiggle is your customer, and the amplitude, the squiggly line, is demand, sales, and so forth. If a customer, a small change in a customer order, size, profile, whatever, can manifest itself, you can see, as you go back through the supply chain up to the supplier, and it can get pretty nasty pretty quick. On the right-hand side of the graph, you can have the same situation existing at your supply base. In this graph on the left of the box is potentially a foundry. A foundry can experience a risk event. It's happening all the time. And essentially that risk event can manifest itself with the squiggly line. It can get amplified rather quickly into somewhat of a very bad situation, disruptive situation, all the way up down through the customer. And if you add those demand and supply shocks together, essentially you get the W-like recovery. And we tried to give you a sense of what that looks like in terms of the graph. We coined it the W-like recovery early on in April in 2020, excuse me, to all our clients and to our webinar attendees. You can see the x-axis in the bottom chart is just months for examples. And then what we did is we profiled 4 different types of nodes within a supply chain. Blue is retailer, red is wholesaler, green is a distributor, and orange is a manufacturer. And essentially you can see how that bullwhip effect can produce rather heavy disruptions throughout the supply chain. And what do we mean by that? Delays, and time is money in supply chain management. So we wanted to give you a thumbnail sketch of the bullwhip effect from our point of view. Okay.
All right. Thanks, Greg. We have a question here or a comment from someone, from one of our participants. So thank you. It's a little bit off topic from this particular graph, but I think it's on topic for the overall, and I think we can answer it now. It says traditional push is very expensive in retail, transportation and alike. Pull is simpler, but to move from push to pull is not easy. I think some will fail simply because these firms do not have the infrastructure to execute a pull system. comments, Greg? I know you have comments on this. So
Yeah, it's a good observation that you are correct. It's the push-pull, which we'll talk about in detail, I guess, in our next webinar. We do a lot of work with retail, and we've done work with the exemplar in retail, who is Zara. Zara is a retail apparel manufacturer and distributor. They have stores. They're excellent in terms of supply chain performance, and they're even better in terms of supply chain risk management. And why? Because they have a pull supply chain. They put it together 12 years ago. Their competitors push supply out and hope people buy different style, size, and color in the stores. Essentially, Zara is a pull. Zara has 17 different seasons. Each season is about 2 to 3 weeks. They communicate with their customers. They tell them when the product's coming in. They load it up. They have small lot sizes. They don't have any inventory write-offs, because by the time the lot size is in the stores, they are bought by the customer. They have an unbelievable cash conversion cycle, minus 45 days. That means they're a bank, and essentially they operate and manage their supply chain 24/7, 365, using a multi-million-dollar supply chain risk war room. Pretty compelling.
Pretty compelling. So there is a way to smooth this out, and if you are that nimble, the Bullwhip Effect, you can capitalize on it because you have that flexibility that we're just talked about. So, Dani, any comments from you on this slide, the Bullwhip Effect?
You have to adapt to today's reality, because what worked before will not work now. So you have to be flexible and realize that it's a different reality today, and it's like the horse and the wagon. When the car came out, everybody said that the car is noisy and the horse is very elegant. How many horse and cars you see today, and how many cars you see on the road? It's a brand new reality people have to adapt to now, or business have to adapt to now.
Thank you, Dani. And with that, I think we'll move on to the next on supply chain management readiness, and with a demand perspective.
Yep, good segue. Essentially, we don't profess to have a silver bullet, folks, but we've as the cartoon demonstrated and the statistics verify, we are still living in the brave new world. We call it the VUCA world. Volatility, uncertainty, complexity, and ambiguity. That's the new normal in supply chain, folks. I don't care what industry you're in. What we've put together over the last 30 years, and especially the last 12 years, is a tool that can basically assess 2 areas of your supply chain. One is to describe how mature your supply chain processes are, and the other is risk. And we'll give you a quick thumbnail sketch of what this chart means. First, there are 13 tenets. Our point of view in terms of what make end-to-end supply chain processes work. All right. And if you look at the star chart, the lower the number in close to the middle, the more mature those processes are. As you go through, there's about 100 questions. This is an online survey. As you go through those questions, you can see a company's response. That's the black line that you're looking at. And remember, the farther away the responses are from the center of the chart, the less mature the supply chain process is at that time. Secondarily, we developed risk levels within the maturity model. So you can see the green circle that denotes where best-in-class companies tend to operate. The orange circle is essentially moving forward, but you're not best in class. And then we have the red ring of fire. Any responses near the red ring of fire says that that supply chain process is pretty immature, which leads us to believe that you have much higher inherent risk within your supply chain. So finally, on the left is a best-in-class rating. Once you go through this survey, you get a best-in-class rating that a company receives within this free tier 1. This assessment is free. We have 3 additional tiers of sophistication in this tool, but that's for another website. So we wanted to give you a quick thumbnail sketch of what you're looking at.
Thanks, Greg.
Jim?
I'd just like to make a couple of comments here. And that this is broken out into 3 areas: strategic in the blue, red is tactical, and that's right, tactical, and the gray is operational, right? So the other thing that I would just want to comment here is that, you know, demand management is one of the tenets, and that's what we're focusing on today. And it's often ignored relative to the other tenets. What I see in most companies is the last thing that folks want to work on, because nobody owns demand management in companies, because sales, it comes through sales, and it's that handoff between sales and operations, which is very, very difficult. And they're kind of like the ends of the business, so to speak, talking to each other. And if you don't build that umbilical cord and make it strong, you're never going to get a handle on demand. If you never get a handle on demand, you're going to continue to make the wrong product, and you're going to have slugs. So what Zara did was they closed that gap, as Greg showed or shared with us. So I would just be cognizant that this is probably one of the most overlooked areas, and even be pre-pandemic, but even with the pandemic now, it's even more important than ever. So a lot of people are focusing only on the supplier side and not the customer side. And if you do that, you're going to lose. So that's my comments on this slide. Dani?
Couple of things to focus in is information system and integrated supply chain. You have to have modern ERP software to know what you have available in inventory. You might have 500,000 products, but you allocate for production 300 or the future orders. Your net inventory is 200. You need to know when your next shipment will come. If you don't have good handle over it, you will join the Toyota and Honda club. Manufacturing disruption and plants are closing. Second issue is the integrated supply chain. In today's M&A, companies buy other companies. They end up with 2 ERP software. Then it's a hopscotch for the user, jumping from one software to another software, an integration issue, resulting in corrupted data. It's 2 factors that affect company very badly today.
Great. Thanks so much, Dani. And we have a question from our audience. Do matured companies narrow their product portfolio? I think this gentleman has read our slides ahead of time, so he knows what's coming. So we will address that in just 1 or 2 slides. So perfect question. And we'll be addressing that very shortly. So with that, we're going to move to the next section of the retail omni-channel revolution, delivering to the last mile. We're going to go back to our omni-channel graph chart that was created by McKinsey. And we're going to put the last overlay on it on 5 key metrics of lead time, degree of productivity, volume handling capacity, inventory holding capacity, and cost of operation. 5 very important metrics. And we can see there that the lead time goes from high to low, from ship from the factory to the consumer, and so forth. We see the high to low, and then it's reversed, of course, for cost of operations. So in each of these areas, we can see that we're going to be shipping earlier and earlier from the factory, which is now creating more and more DCs. We see them popping up all over the place, and more small, what we call warehouses doing packaging, so cross-docking and so forth. So this is a time of change and disruption where that last mile is trying to be optimized. And there's an awful lot of infrastructure being created for that last mile. There's also things like onshoring that we keep talking about, but it's very difficult to do for obvious reasons. And automation and the automated warehouse and the automated manufacturing facility, I think, is what we'll start seeing creeping in over the next 5 to 7 years as that becomes more and more a mainstay. Greg or Dani, your comments?
What we had today, where customers ship to the warehouse, factory ship to the warehouse, to the distributor warehouse, and distributor shipping to the store, it's a brand new world now. Amazon is a good example. They bypass FedEx as the main carrier, and they have people in the cities on a bicycle deliver it straight to the customer, to the consumer home. It's a brand new reality we're facing now of bypassing the major carrier like Amazon or FedEx, becoming people on a bicycle delivering it.
Yeah, absolutely. Greg, your thoughts?
It gets back to push and pull. All right. If you can't adapt to push and pull like Zara did, and everyone in their industry is attempting to copycat what they do, it is not easy. I'll give you an example. I worked for IBM for 8 years. When Dell did the pull versus push and pulled the rug out from under their competitors, including IBM, it took IBM 3 years to transform their supply chain from a push to a pull. It is not easy. Got to be committed.
Yeah, great point. I think that really leads us well into the cost to serve model, Greg.
Yeah, you bet. It's a great question, Andre. Terrific. We thought we'd pause here during the session and discuss a method called total cost to serve. It involves 2 elements, critical elements in supply chain performance and risk management. One is customer segmentation, and the other is product portfolio management. All right. So I'll give you a brief discussion or brief profile. On the left, on the y-axis, exemplar companies do this. They classify and stratify their product codes, their finished goods, stock keeping units, not just by volume and cost of goods like we're trained at Apex, all right, with the A's, B's, and C's. They do it on margin. And then they identify and codify them as A and B, the good guys, C, D, and E as the dogs. On the x-axis on the top, they also do this by customer. If you're not segmenting your customers, you are leaving a lot of money on the table in supply chain, and your supply chain is at risk. The exemplars do the same. They codify and classify their customers by margin. Sorry for the call, but I have to keep the phone on. And it's A and B customers, and then C, D, and E type customers. And then what they do is they essentially develop a 2x2 matrix associated with the combination of products to customers. And you can see the 2x2 profile on the top left, very profitable. Why is that? Because you have A and B good guy products, and you have A and B good guy customers. Down the bottom left, you have an interesting situation. They call it copper. You have dogs and cats, meaning low margin, low turn, low volume, but the A and B type customers buy that product. You want to keep them happy. Top right, you have an interesting situation. You have dogs and cats in terms of customers, but they buy essentially hold on. They buy essentially good products. Then down on the bottom, we have what is called the coal quadrant. Very unprofitable. Why? Because you have C, D, and E products by margin and volume and turns, and you have dogs and cats in terms of marginal customers. So they essentially then take that data and they plot the combinations on those 2 by 2. And then essentially it's visual. Most of us take our cues visually. Once you have that, then you can start to evaluate the combinations in the copper and the coal on the bottom 2 quadrants, and you attempt to move those combinations the best you can above that diagonal. It's not easy, it's very emotional, but if you do this, it allows companies to effectively manage complexity and free up your capacity to do what? To serve more profitable customers with more profitable products. That's what we call total cost to serve. And we have an example, I think, on the next page. It's P&G, Procter & Gamble, everybody knows them. This is back in 2014. They said, listen, we got 160 brands, we're going to get rid of 90. So we're going to have 70 brands left. Do you think that got a lot of media attention? It did. Those 70 brands represented 90% of their $83 billion revenue. Therefore, the remaining 56% of brands, which are stock keeping units, equaled only about 10% of their revenue. Their CEO at the time told the street in the middle of 2014, we're going to create a faster growing and more profitable company that is far simpler to manage and operate. Their shares jumped 3% that day. So what happened? What happened 15 months after the statement? Well, here was their July 2016 fiscal results. They go from June to July. I don't know why, but this is their fiscal results. Net sales decreased by 8%. Well, that's no surprise. You're getting rid of marginal products. Their net earnings per share increased by 51%. Their adjusted free cash increased by 115%. So what'd they do? The company gave back $7.4 billion with a B to the shareholders in the form of dividends. You think everyone was happy with that strategic decision? You know, it's a rhetorical question, but it is about segmenting your customers and segmenting your products, and it's called total cost to serve. Back to you, Jim.
Thanks, Greg. Yeah, and I'll just say that I've followed the same practice even in a small startup division. We moved from 20% of our margin coming from, or 80% of our margin coming from 20% of our customers, and we flipped it where 80% of our margin, all those customers, 80% of our customers were giving us positive margin. We had, actually, when I left, we had no negative margin customers. And it's an evolution, and it can be done in any business, any type of business. It's not limited to products. It can be done in the service industry. It's a long slog, a lot of hard work, but it should be something that you're always working on all the time to proactively manage your cost to serve. Dani, any closing comments on this?
Yeah, in today's reality of inventory shortage, you cannot buy everything. So you have to know which product are moving in order to maintain your inventory level. A second issue is, how do you allocate your inventory? You cannot allocate your inventory to the big guys like a Walmart or Amazon and neglect your small clients. Because if they drop you, you end out of business. So it's a very, very delicate balance. The available inventory, who do you allocate it to?
Very good. Okay, fantastic. So with that, we're going to move to the next section, which is leveraging ERPs to enable robust demand cadence capabilities. And with that, Dani, kick us off with this.
Today we live in a brand new reality. You have to have integrated ERP software that does manufacturing and distribution under one umbrella. It's the world of M&A, where a manufacturer buys the distributor in order to lower the cost, and distributor become just as smart, become by the manufacturer to save on their issue. Warehouse management is the next issue. You have to have integrated software with warehouse management. If you buy third-party warehouse management, you end up with integration issue, Mercedes engine and an Audi transmission, data integrity. And you have to keep the whole thing under one umbrella in order to be able to survive in the environment. The next reality you're moving to is the cloud. 9 out of 10 companies today work on the cloud. The pandemic forced us to be on the cloud because places are closed. Customer buying on the cloud now on the smartphone. So it's a brand new reality. Now we need integrated ERP software that covers the manufacturing, distribution, finance, and on the customer and the order. You need to be flexible to get the orders in either VAI or smartphone internet. Customers go now on their phone, view their what they bought in the past and order on the phone. The phone gets updated to the host in real-time mode. If there is no connection, it stays on the phone until there is real-time connection. Another issue is you have to track which products are moving fast. And you cannot buy all products, so you analyze what products, and you order those. The sales rep, instead of like the old world used to call in the order or fax it in, they enter it on the smartphone now, and they update the host. We need flexible interaction now between the smartphone, the internet, and the into total ERP software. It eliminates the needs to take order on the phone, and it's all come electronic now.
Thanks, Dani. Yeah, I concur that, ERPs all have to have this functionality. I think it's table stakes. BAA has it. But these are the things that we need to be looking at is the total cost of ownership, OTIF, at the SKU level. With that, Greg, any comments on this?
Oh, it's all part of visibility, gaining more visibility. Remember, from a risk point of view, what you don't know about your supply chain can and will hurt you.
Yeah, well said. All right, and then Dani, you want to just share a couple of the screens that you would see from the customer portal perspective?
When the products are being shipped to the customer, you have to allocate it to the right designation. The computer will designate how much will fit on the truck, and the less order will be at the back of the truck, and the first delivery at the front of the truck. But the end user can go in and change the priorities, because if a customer calls and said, I must have it immediately, and I cannot wait, then the route has to be changed to deliver it. It's total flexibility overriding the computer. We need to streamline the operation. Software does, it tells the truck driver, it's like a map quest, where to go, where to drop it, and it tells the host computer where is the truck. With the cost of fuel going out of control today, you have to have a very efficient way for the truck to deliver the merchandise to the customer and get total visibility, who got it, when it got it, how they got it. Another issue is when the customer received the product, the tractor make the customer sign that he received it and update the host. Whatever the customer refused to take, it goes to the host and he gets instant credit for it. Next year.
Yeah, so I mean, this is absolutely critical, is that you have that track and trace. So from the time the customer places the order all the way through the delivery of the goods, having that real-time track and trace is incredibly important. And having that visibility and finding out where in your supply chain, where in the routing of your transportation, I should say, where you're having hiccups, and then proactively looking at route management, of having alternate routes if there's different things, and a fire or a hurricane, or always having alternative ways to look at your supply chain to make sure you're always delivering goods at the lowest cost, so that you get back to your margin to serve, as Greg mentioned before. You have full visibility into that, where you can see, is this a one-off event? Is there something you can prevent it in the future? So this type of software is absolutely critical to have, and creating that visibility to make better proactive decisions. It's kind of like a baseline that you need. Greg?
No argument with that.
Okay. All right. With that, I think we're gonna end it here with a case study with Dani.
This is a case of an air condition distributor with 100 branches nationwide. Before it went real time with the web, at night time they upload the data to the host computer, and if the upload failed, they had to redo it. It created a havoc at the host location because it did not know what to be shipped and what to order. They had to change the entire operation by doing it, moving into real-time information. At this point, they have visibility of what to be shipped to the customer, where to ship it from, and how much. A good example, Ohio location might be short of inventory, but the next state has too much inventory. So with a common carrier now today, you go to the other warehouse and ship it from the one location to another location, which allow you real-time ability to know where in each location and where to ship it from. In the olden days, they would take the inventory from one warehouse and transfer it to the other warehouse. Today, it's an absolute issue, because with common carrier, you can just transfer it one to another. Daily inventory before it was updated, the inventory was updated on a daily basis. So you only were a day behind of what was happening in the inventory. It resulted in some shortage of inventory and excess inventory at the branches, which create a whole brand new situation. One warehouse with overstock, one warehouse with understock, so result in transferring data back from inventory back and forth. This was eliminated today by having the real-time information and being able to see was it each location and ship it from the right location to the remote customer.
Sorry, Dani. Are we good to go to this slide?
This is today's reality. They have the first internet line, real-time information, knowing what's in each location and how much it is. The purchasing department know what to order now based on the customer supply and demand. Remember, the whole reality changed. Before it was shipped to a distribution center. Now it's being shipped to the customer. And a new factor is the contractors are entering on the smartphone at night, or the order on the laptop, the orders they need for the next day. They establish 3 shifts, and when the customer come in the morning, the contractor come in the morning, the package is ready for them, put in the back of the truck and drive off. It's eliminate the data upload and download, and information in real-time mode. Now you can ship the information in real-time mode to the customer location, the consumer home, or the contractor can pick it in the morning. Let's eliminate the upload and load of the data before, and the contractors on a smartphone order the information at night and they deliver it. That's resulting in customer satisfaction of 20% over the past 3 years, which in today's reality is a major factor. You're on mute, Jim.
There is one question from the audience. Thanks, Dani. There is one question from the audience that Greg could probably answer. We're going to definitely answer in the next webinar. So I think we'll probably hold off on it on the normal maturation process of push greater than pull and so forth. So it's a great question, and it will certainly be a focus of the next webinar, because that is the focus. That is the topic. So Greg, do you have any closing comments from your perspective? I know you have to leave early.
Yeah, I do. Sorry, I got a client call in 5 minutes, but just a quick comment to the crew on the phone. Demand and supply volatility, it's here to stay, folks. I wish I had a better answer. Supply chain complexity, it's going to be with us for a good long time. Things you can do. End-to-end supply chain visibility is a must to survive and thrive. Think of end-to-end supply chain visibility and optimization, which we've been talking about and we will continue to talk about in the next 2 webinars. And think of risk. Think of risk as not only negative, but an opportunity as well. One company's risk event in this VUCA world could be your risk opportunity. So with that, I have to leave early, and I appreciate everyone on the call, and talk to you in a couple of weeks. Thanks, Jim.
Thanks, Greg. And with that, Dani, you close us out with how the ERP benefits of VAI, I think, are very aligned to what Greg just shared with us. So wrap us up here, Dani.
Yeah, this is a very important factor. Having an integrated ERP software that includes the warehouse automation and financial, and which enable the user to have real-time information. If you don't have if you have outdated ERP software, and you must buy warehouse management software now, you run into integration issues. We just got a new client that has 6 modules interfacing to the main host. Integration issue, corrupted data, and having to search multiple database. It creates a headache for the users, hopscotching from one data to another one. Having one integrated software enables you to know who to buy from, how much to buy, and when to buy. Inventory is very scarce today. Another issue is landed cost. Container have reached $25,000 at this point. You have to keep track of each particular shipment, average order cost to make sure you did not sell it below your cost or at low gross profit. Integrated ERP software enable you to check the whole thing and have analytics software that a 30,000 foot square view enables you to see what you have in inventory, what's allocated production, future order, who to order, when the next shipment will come, and you can plan your next purchasing, and the most important thing, who to allocate it to. You have to, because short of each inventory, you have to allocate the inventory appropriately. Now, evaluating a customer, who do you ship it to? The customer who pays his bill in 30 days or 120 days. It's a brave new world of allocating inventory to the right customers now. That's a brand new reality we are facing now. Prior to the cold vet, the bank and insurance company would live with the fact that you close your warehouse for a month, for a week, and count the inventory. Today, it's a brand new reality. Because of volatile reality, company go out of business. The bank is skittish. If the company goes out of business, they own the inventory. Ability to download the data spreadsheet in 5 minutes and give to the bank makes them happy. The insurance company, not trusting the number you give them because it might be outdated, will raise your premium. That's a factor we must be considered today in today's volatile reality.
Thank you, Dani. Great way to wrap up. I hope you enjoyed the webinar today. And if you have any questions or comments, feel free to email us and contact us. At any time, we're here to help you. Again, Greg and my email are part of this, and Dani's. So please do reach out. Again, EIG is made up of 50 consultant companies and SaaS providers that will help you find that self-funding and self-sustaining solution. So don't look at these solutions as something that are pure cost. I think there are clear ROIs on doing this and saving you time and keeping you in business throughout this tumultuous time. And we are probably not even at the peak yet of the bullwhip effect that we mentioned at the beginning of the webinar. So again, EIG has over 50 consultants. We welcome you to contact us. And with that, Dani, do you have any closing comments of the last mile cadence?
It's a brand new reality we are facing to. It's like the horse and the car that create a new reality. The new consumer buying on the internet today create a brand new reality for us, for the distributor, for the manufacturer, for the shopping mall who are closing. We have to adapt to the new reality and make sure that we are very flexible to keep up with the new time.
Thanks, Dani. And I'll just add the comment of visibility, communication is the way that we're going to be able to survive and thrive and look at these risks as opportunities. Don't look at them as something you want to avoid. If you proactively look at it, you'll be able to, outlast and beat your nearest competitor. With that, we'll wrap it up. Thanks again for joining us and your comments. Really appreciate it. I hope you enjoyed the webinar, and we'll be sending out the webinar by the weekend. Thanks so much. Have a great day.